Welcome to Econoday Unplugged. Each week, our expert team explains the relationship between economic announcements and market reaction. For over 25 years, Econoday has provided value for the investment industry, amassing a comprehensive, machine-readable database of global market events. Econoday provides solutions for macroeconomics, sovereign debt, agricultural commodities, and historical data, all delivered via API, XML, and HTML. Connect the dots with Econoday. Subscribe to the Econoday Unplugged podcast and go to www.econoday.com to follow market events.
Hello and welcome to Econoday Unplugged on Wednesday the 19th of June 2019. Mark Pender is across the pond stateside, Brian Jackson is in Sydney, and I'm Jeremy Hawkins here in London. So, albeit with an inevitably wary eye on global trade, and increasingly in the light of recent Gulf developments, geopolitical issues, financial markets this week have refocused on the central banks. We just had results of the June FOMC meeting, and we're only hours away from knowing what both the Bank of Japan and the Bank of England plan to do next. So, let's get going then with Mark. What's hot off the press from the Fed, and in particular, were there any surprises from what Mr. Powell had to say today?
Well, I guess the surprise, if there is a surprise, is the culprit, and that's business spending. What we have is drag out the old word sea change here. The Fed has really been turning on a dime for a monetary, for a central bank. They were raising rates in January. In December, in their January meeting, they shifted to wait and see. The last two meetings was this is a good place to be, and now it's not such a good place to be anymore. You wonder how much the market expectations were leading this, how stuff like the ECB, Draghi talking about considering rates, things like the Reserve Bank of Australia coming out very strongly in that regard. I think the force of the economic explanation of such a dramatic change, I'm not sure was really there. Powell underscored that consumer spending is reliably strong, and that's the bulk of GDP. He did cite, without, it was a low key, even for a Fed. It was a sad funeral. I mean, it was very low key. And they cite, so he never cites anything with any specificity to avoid any political issues. But he did cite trade, slowing in global manufacturing as key readings, and then turn back on business investment. But if you look at the latest data, and the things he's citing were possible. We've been talking about this, the Boeing 737 MAX and the implications. Still unclear of what that means for the U.S. manufacturing sector. But if you look at core capital goods in the last data, they have definitely flattened at a year-to-year base, edging into small declines overall. Durable goods edging into small declines, excluding capital goods. But capital goods are still growing, just not very much, at 1.3% year on year in the latest data, which were for April, which was pretty low, the lowest in several years. But still, there have been other readings that have been low, and it's still growing. It's not like an emergency situation, but it was heightened up. It was put on the platform as a negative area. So the Fed is definitely shifting gears. He also said in his at the very end of his press conference, on a question for Market News, is the balance sheet in play? I mean, they've been in quantitative tightening. Could they shift back or neutralize that, or go back into quantitative easing? And he wouldn't rule it out. He, in fact, said that we're going to, the balance sheet is part of one of our tools, and it's going to conform to our needs. So we have this, like I said, a sea change, and it's still unfolding. They have only one rate cut penciled in for next year in their quarterly FOMC forecast, which he downplayed the importance of. But it looks like it's just right in line with the global situation that both of you guys cover.
So in terms of if I'm right, we had the updated FOMC forecast today.
That's right.
So were they very different from the previous set? To the extent that they actually sort of justify this apparent, what's going to be an easing in the future?
Well, they had a few notable things to it. Inflation was definitely edged lower, but not GDP, which was edged higher, and also not the employment rate, which was edged lower. Those are a sign of strengths. But for the first time in the 7-year history of these forecasts, a rate cut appears, and that is last year. But it's also cloaked. I mean, they don't go out to three places. They only go out to one place, so you don't know if it's a quarter point move or you really don't know what the size of the move is. It's definitely an incremental move. Penciled in likely a quarter point penciled in for next year, and that's the first time that we've seen this. But Powell has been very dismissive of these forecasts, and he really hasn't been able to articulate particularly why. He said in today's conference that it's used more as a inputs into an immediate decision that we make. It's not supposed to really be a concrete forecast of what everyone expects. So, which is kind of how it can be taken. It has been taken in the past. So that they may be coming to an end if he throws his weight around. I think he could scratch these, which he may want to do.
I find it interesting because presumably from what you're saying, the unemployment rate forecast must be at, well, presumably historically low levels. And
Yes.
yet the Fed's talking about cutting interest rates when if you wind back a few years ago and look at unemployment where it is now, let alone where it might be, it's all about, should the Fed be tightening? So the Phillips curve per se has gone completely out the window.
Yes, I would say so. At least the Fed has some place to go. They have managed in their several years of raising rates to get to this 2.38 position above zero. So without a lot of fuss, they can begin to signal what their policy change is going to be. But the other banks, the European Central Bank, doesn't have that leeway, and so that's really my question for you, Jeremy, is how if Draghi is going to start being stimulative, is it going to be in these unconventional tools that are difficult to explain to the public because they haven't been particularly articulated by the policymakers themselves?
Very fair question, I think, and not only perhaps have they not been particularly well articulated to the general public, but I also think amongst those people who supposedly do understand the measures, there's no great conviction that they worked in the first place. So just to quickly point out then that although there was no ECB meeting, there might just as well have been, because we've seen some fairly dramatic moves in European bond markets coming out during the course of the last day or so, courtesy of President Draghi, who yesterday suggested that, essentially the ECB has shifted from a no change in policy unless the economy slows further stance to additional accommodation is going to happen at some point if the economy doesn't improve. So in other words, there's a clear shift towards a blatant easing bias here. Now, Mr. Draghi also went on to kind of intimate that in terms of what the easing might look like, were it to happen, it could be either additional quantitative easing, so in other words, a reopening of the old asset purchase program, which they only ended at the back end of 2018, so it's only been shut for less than 6 months now, or it could indeed come out in terms of a lower interest rates, and that would really go against what they used to say when they've really intimated that 0% interest rates, and that's where their benchmark refi rate stands at the moment, was pretty well the bottom line in terms of the lower bound as they see it. So I think, yes, it's a perfectly fair question to say what can the ECB do now. They don't really have that much room on interest rates. It's questionable as to whether pushing interest rates into negative numbers rather than being at zero, will that make much difference? They're already throwing trillions at the Eurozone economy. They maintain that that's actually provided some support for growth. And I think, to be fair, that's probably true, but at the end of the day, they're not meeting their inflation targets. So I think, to me, it seems that the bottom line really for the ECB is it the case now that the relationship between inflation and economic growth has changed sufficiently that the inflation target itself is simply unrealistic? Is it possible to get close to a 2% inflation target? Perhaps not anymore.
Jeremy, real quick, we have to bring Brian in, but just I just want to ask, as the policy impact, is there, like here, when rates were so low, retirees weren't able to earn very much or anything at all on their traditional savings accounts. And this became a political issue. Is this the same in Europe?
Yeah, I suppose we've got to say, in terms of certainly for the more elderly members of society, it's been an issue for some while now, because rates are so very low over here. Indeed, if you're looking at some of the yield curves for Germany, for example, going out to almost 15 years now, we're talking about negative interest rates. So it is a problem for the older members of society. But at the end of the day, I think the ECB's attitude has been, well, yes, there will be some distortions which we're not particularly happy about, but ultimately, by lowering interest rates, by lowering the cost of borrowing, right along the curve, it should promote additional economic growth, which will generate income, which ultimately makes it better for everyone. But yes, there are going to be increasingly, political problems and difficulties, I think, coming out of any additional cut in interest rates, in particular, that the ECB might make. And indeed, it's always worthwhile remembering, of course, that for the more hawkish members on the ECB, so the likes of, coming out of Germany and coming out of Austria, they weren't particularly happy with the extended quantitative easing in the first place. They weren't happy with interest rates being cut as low as they were. So it's going to be very interesting to see what happens with ECB policy over the rest of this year, particularly since, of course, Mario Draghi himself will be leaving at the end of October. Now, another country with zero interest rates and perhaps not a lot of room for manoeuvre is Japan. So, Mr. Jackson, Bank of Japan meeting, what might they be doing this week?
Yeah, well, I mean, the consensus is that there'll be no change in the policy settings. They're meeting just in a few hours. And as you know, they've had that sort of slightly negative interest rate now on hold for several years now. But there is definitely discussion that they might have to do more, particularly if we do see the Fed move in the next few months. And if that has an impact on the dollar and sort of pushes up the yen, hurts Japanese exporters, then you might see increasing pressure on the Bank of Japan to act. Now, it is interesting that we had BOJ Governor Kuroda. He actually gave an interview last week, and his view was that no, we're not running low on ammunition. We've still got options available to us to do more stimulus, but he believes, at least for now, that that's not necessary. So he's still reasonably, optimistic about the medium-term outlook. He thinks that, we are going to see a bit of a pickup in global growth, and he's still, against all recent experience, he's still expecting that that inflation target is going to be met eventually.
So, Brian, what's kind of the main focal point now for the BOJ? Obviously, they got the inflation target, but does it come down to, policy, at least at the margin, is becoming particularly susceptible to changes in the level of the yen?
Yeah, I mean, that's always a big focus, obviously. And, I think they are definitely just concerned about the global trade situation and the fact that they could be damaged quite significantly if the yen does go up too high. It's interesting. We've had this over the last week, trade numbers from China, Japan, and Singapore. Singapore, often a very strong barometer of regional trade flows, and they're all showing, as you would expect, some significant weakness over May, not just in exports but also imports. It's happening on both ends. Trade flows are just contracting all around the region, and so and that's a big concern, obviously, for policymakers right across the region.
Can I ask you a question on China? Taken on from what you're saying about trade flows. If I got my numbers right, if I scribbled down here earlier on today, the latest figures for May. This is just looking at what's going on with tariffs and so the trade flows going into the US. So we've got exports going into the US as of May on a year-on-year basis down 4.1%, but imports coming out of the US down almost 27%. So it leaves then the sort of the bilateral balance of a surplus for for China, US, about 5.1% bigger so far this calendar year compared to a year ago. So does this sort of mean that all the tariffs and everything else that people are talking about at the moment may not perhaps be hurting Japan, may not be hurting China perhaps as much as originally expected, because for whatever reason China appears to be getting out of it better than might have been anticipated?
Yeah, I mean, it's hard to read too much into just 1 month's number.
Yeah, sure.
But, there's still going to be a large bilateral trade surplus with the US for China going forward, and it's hard to see that being completely eroded. No matter how hard the US administration pushes on tariffs. It's obviously just having also a flow-on effect to other links in the supply chain in the region. So it's hard to sort of discern exactly what the overall impact is going to be.
I'd like to add, though, that politically, even though the Chinese gap will still remain very strong, the direction coming down will be a boost to U.S. GDP.
Yep.
Fair enough. Okay, well, since we're talking about central banks, I guess we should have a quick bit on the RBA. Cut interest rates to a new record low of 1.25%, and hints from the minutes that there may be more to come.
Yeah, more than hints, really. Very clear guidance that they still think that there'll be some more scope for rates to fall over the next few months. A lot of people are now sort of penciling in another 50 basis points at least over the next few months to 0.75%. The minutes make clear that they're really focusing on the labour market. They think that at 5.2%, the unemployment rate is above where it could be. They think that they could get it down well below 5% and still not trigger an unwelcome increase in inflation rate. Remember, they actually do want the inflation rate to get a bit higher because it's been below target for a while. So that's why they think we can push on the interest rate lever a bit more, hopefully get the unemployment rate down, get a little bit of inflation back into the system, but still not too much. So they're sort of playing around with some of the policy variables and the levers, and they think that they definitely need to get that spare capacity in the labour market utilised to help push price pressures back up.
Fair enough. And since we got here, Brian, just a quick one on the RBI. Since we last spoke to you, we've had another cut there, 25 basis points down to 5.75% earlier on this month. Is that the bottom of the RBI cycle? Is there still scope for lower rates there too?
Yeah, that's a little bit more. I think they are closer to the end. They've been pretty aggressive over the last 6 months, really, since the new governor came into town. And, we are starting to see the inflation rate stabilise, and perhaps, obviously it's always depending from month to month on what goes on with food prices. But, I think the concerns aren't as sharp as they were when, he came into office. And so, I think, a good chance that there might not be much more to do there.
Okay, fair enough. Thanks for that. Right, quickly before we finish then, we also have a Bank of England meeting this week. That will be taking place on Thursday. For the poor old B of E MPC, they got all the unknowns associated with Brexit still to be faced. And of course, they now have the prospect of a new Prime Minister as well. In terms of the way the votes are going at the moment, they should be whittling that down to 2 options by the end of Thursday. It looks as if Boris Johnson, the former Foreign Secretary, will be one leading candidate together with a another. Whoever the a another is, bottom line is that both candidates are likely to be more pro-Brexit than previous Prime Minister Mrs May was. However, of course, it's always worthwhile remembering that as far as Parliament's concerned, they don't want to leave the European Union without some kind of a trade deal. So the bottom line as far as Brexit's concerned at the moment is that no one's really got any idea what the final solution is going to be. So the poor old Bank of England, which is supposed to be coming out with a forecast about what's going to go on to the economy, they're just about as clueless as anybody else. So that really means that it's almost certain, hopefully anyway, almost certain that we won't see any kind of change out of the Bank of England on Thursday. So we'll see interest rates, bank rate being left at 0.75%, no change to quantitative easing either. One thing I would quickly mention in terms of the UK, just in terms of the economic data, more and more now we're getting evidence that what was a relatively strong first quarter of the UK economy was really heavily predicated upon a build-up in inventories by industry, which at that time was still assuming that Brexit was going to happen at the end of March, the original Brexit date. Of course, now that's been extended until, as far as we know, the end of October. That remains to be seen. But it's left in this industry in the UK with a lot of excess inventories. That's now being unwound, and it looks as if we could see a very soft second quarter GDP figures throughout the UK. So in terms of trying to find out what's really going on over here, you at least as a starting point need to put a straight line between first quarter GDP and second quarter GDP to try and determine some kind of underlying trend. Okay, anybody else for anything else since we've been talking for a little while now?
No, it's all about central banks at the moment.
It is all about central banks, isn't it? And good luck to them, I say, in current circumstances, because who would be a central banker? Okay, in which case then, on behalf of Mark, Brian and myself, thanks as always very much for listening. So there is a lot going on at the moment, so do keep checking in on Econoday's global economic calendar to keep up to date with the latest movers and shakers in the world of capital markets, and we'll be back again next week. Thanks for listening. Bye for now.
In response to regulatory requirements under MiFID II, Econoday has launched the first and only third-party sovereign debt auction database that provides pre- and post-trade transparency. Our machine-readable database tracks historical and immediate auction data of 10 countries, averaging roughly €1.7 trillion spread over 700 auctions each year. Our specialists cover cross-country comparisons of rates, spreads, coverage and volumes in trading decisions. Go to www.econoday.com and follow @Econoday on Twitter to learn more.